Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valinsky, sitting in to do our interview with Jesse Eisinger. He's a senior reporter for ProPublica. Jesse, how you doing this morning?
Good. Thanks for having me.
Our pleasure. Well, we always like to get a little bit of the education and market background of our guests. Can we start with that?
Yeah, sure. What you want to, hear about the log cabin I grew up in?
Well, how about a little bit after that?
Well, I'm just a journalist, so I graduated from college and then didn't have any idea what I wanted to do, so I got into journalism, a career notorious for not needing any skills, and then kind of kept going, not having any idea that I would stick with it. And I fell into business journalism. I was a liberal arts major from a liberal arts background. My dad was a professor, so I had no idea about anything to do with business or the capital markets. Quite literally, I don't think I knew a business person growing up in my college town. And so it was all kind of new and interesting to me, and kind of adventurous and exotic. And, I was looking at this kind of bizarre priesthood from afar and trying to understand it. And I covered the capital markets for a long time, and finally wound up at ProPublica, which is a nonprofit investigative news organization. And I still cover Wall Street much differently than I covered it from the beginning, from a kind of investigative perspective.
Okay, you already touched on the next thing we were going to grab you for. So you do mostly investigative work on Wall Street for ProPublica then?
Yes, exactly. I have a column for the New York Times Dealbook section, which is kind of commentary, but I take kind of investigative principles with that commentary. So I try to hold the powerful accountable and try to expose abuses of power. But my day job is doing long form investigative work for ProPublica, and ProPublica's model is we're a nonprofit, so we raise money from foundations and individuals, and we don't have to make money with our stories. We don't make money through advertising, and we just do investigative journalism. We do things on civil justice, healthcare, national security, all sorts of topics, and I cover Wall Street and finance generally. And we look at the same kinds of things that I do in my column, but more expansively, abuses of power, things that are wrong, try to hold the powerful accountable, afflict the comfortable, and comfort the afflicted.
That's a perfect segue into our next question. So you won a Pulitzer Prize for national reporting for a series of stories you did on questionable Wall Street practices. What inspired you to do that report?
Well, we had endured the terrible crisis of September 2008, the big financial crisis. This was in the summer of 2009 that we were reflecting on it, and guys from National Public Radio, Planet Money, came to us, Adam Davidson and Alex Bloomberg, and they had done a big piece looking at the crisis, actually before it had happened. But then they asked this very good basic question, which was, what did bankers know about the crisis and when did they know it? And what was interesting about that moment, the summer of 2009, was that there had been an enormous amount of attention, journalistic attention in particular, to the events of the fall of 2008 when Lehman failed and AIG was taken over and Merrill was sold to Bank of America, et cetera, et cetera. And and that was completely legitimate since those were cataclysmic historical events. But we realized that there was a giant hole in the coverage, and that if we looked back to sort of 2006, 2007, with the knowledge of what happened in 2008, the crisis, that the world would look very different than it had looked at that time. And so we wanted to look and see what bankers were doing. And we quickly focused on the structured finance market, these complex mortgage securities made up of subprime mortgages called CDOs, collateralized debt obligations. And it turned out that people did know that there was a crisis coming. They didn't know exactly when, but they knew that there was a bubble, and they were taking advantage of it. They were both prolonging it by trying to prop up the market with lousy deals and making a lot of bad decisions, and then they were also taking advantage of their customers and selling them crap, basically, that that they were betting against.
So, Jesse, I'm really curious about how you did your research for that series. I can't imagine it could have been incredibly easy to get people to talk to you. I mean, I'm picturing Robert Redford and Dustin Hoffman and all the President's Men here wandering around to all of these people's houses, banging on their doors. So, can you give us a little insight into that?
Yeah, sure. There was a lot of getting hung up on the phone, and some knocking on doors and having people throw us out of their apartments. And then a lot of it was the way you do reporting on Wall Street, which is over very nice meals in Midtown Manhattan, which isn't so bad. You know, nothing like we weren't meeting any secret sources in parking garages, but it was basically. What was interesting was that there were no public documents at this point. There were no lawsuits. There were no big investigations from the government. There was no discovery in those investigations. There was no public documents that you could FOIA, you know, for under Freedom of Information. There were no documents you could on the deals that you could get that told you anything. There were prospectuses, but the prospectuses were written in a purposely opaque way. And so you had to speak to people. And then that was a matter of trying to find people at banks who worked in structured finance, which wasn't easy, but it wasn't that difficult. There aren't public lists of that, but you could find that out. And then you had to find the people who had moral qualms about what they were doing or had objected to it. And that was kind of painstaking, but there were a bunch of people. There were people raising alarms about it, and they wanted to talk. Then sometimes people wanted to talk to us because they wanted to essentially brag to us about how elegant and brilliant their deals were. You know, people like to get credit for things, and they sort of thought that designing deals where they made a lot of money was deserving of credit. So they outlined that kind of stuff for us. So there were a variety of motives for why people would talk to us. You know, we had to tell them, look, we're going to take this very seriously. We want to really understand this business. These guys who work in complex areas, complex corners of the world in finance, but it's not just finance. You know, you see them in scientists and things like that. They want their stories to be told to a wider audience. And so if you can go to them and say, look, I want to try to understand this in a very, you're in all the complexity, and then try to translate it into English, basically, for the rest of the world, they're amenable to that if you take it very seriously. So that was sort of our approach.
Okay, we're on the line with Jesse Eisinger, a senior reporter for ProPublica, and we didn't give you proper due. In 2011, he and Jake Bernstein were awarded the Pulitzer Prize for national reporting for a series of stories on questionable Wall Street practices. Jesse, got a question for you here. Now, you had to do some pretty investigative reporting here, and I'm sure some people weren't all that happy with what you wrote. Is there been any fallout from these series of stories?
You know, there was. The SEC fined a bunch of the banks for CDOs that we had first exposed. J.P. Morgan, Morgan Stanley, Merrill Lynch, among them, and so that was nice to see. Nobody went to prison for any of these deals, and individuals weren't really fined or even brought up on civil lawsuits, which I think was frankly a failure on the part of the Department of Justice and the SEC. I think that they really kind of dropped the ball in general on financial crisis prosecutions. and in particular on prosecutions and examinations of the CDO business. So there was fallout, and then I'm sure I'm not that popular in certain circles on Wall Street, but fortunately, journalism isn't a popularity contest.
So there was no personal fallout from it, like as
No,
far.
I mean, investigative journalists in the United States have it pretty cushy. In other parts of the world, people run real risks. They have real courage. I mean, the worst thing that can happen to me is that a high-priced lawyer writes a mean letter, or a expensive PR guy gets on the phone and tries to yell at me. But
Good.
that's not that bad. And so, as much as it would be nice to pretend that I'm doing something that's really physically courageous and morally courageous, I can't really. I mean, I think it's the job of journalists to hold people accountable, and it doesn't make you necessarily very popular, but I'm not really running any risk.
Okay, Jesse, so since you did this series of stories, do you feel like Wall Street has cleaned up its act at all?
No, I don't. I think that Wall Street has responded to increased regulation and criticism by becoming more entitled, more petulant, more kind of against the world and resentful, and that they take advantage of customers almost as much as they would, or try to bend the rules to their advantage as much as they ever did. I mean, one example of this is that they manipulated the world's interest rate index, LIBOR, and multiple banks were colluding with each other to do that, and that was exposed. And after that was exposed, then there were other traders who then manipulated foreign currencies. So post the financial crisis and post the exposure of the the LIBOR manipulations, they were manipulating foreign currencies. So I don't think these guys have learned the lesson of the financial crisis. I don't think they feel like they were punished and are scared about punishment or run in fear. I think that these guys are basically the same people they always were, and that calls for increased prosecutions and smarter regulation.
Okay, so we've only got you for a couple minutes left, but I wanted to ask you. Michael Lewis came out with his book earlier this year, Flash Boys. Do you agree with all of the things he's saying in that book?
I mean, I don't agree with all of it, but I agree with the central premise, which is that high-frequency trading has distorted the market, that it's become a force that we don't understand, that could lead to very dangerous outcomes, and that has been inadequately regulated. I certainly agree with that. I think that the problem with high-frequency trading, in a nutshell, is that it's taken over the market, and the purported benefit that we get from it, which is that we have increased liquidity so that prices are lower, transaction prices are lower, is a fantasy, an illusion, and that the moment we have a serious crisis, that liquidity will disappear, and it will exacerbate the declines. So aside from the manipulations that may be going on by high-frequency traders, and I think there are some, but I don't think it's been adequately investigated, we have this takeover of the market by computers and computer programming that is likely to have very bad effects in a crisis, but we have sort of had it run amok. This is Frankenstein's monster that we don't control anymore.
So we had Felix Salmon on the show earlier this week, and his thoughts on Flash Boys is that he doesn't agree that the everyday mom and pop retail investor is being ripped off, which is something that he felt Michael Lewis was asserting in his book. What do you think about that?
I mean, I think that Felix is looking at it in a very narrow way, and I've had debate with Felix about this. What Felix is looking at is that the transaction costs for mom and pop when they enter the stock market have come down because of high-frequency trading. And I think that's indisputable, yes. So it costs you and me much less to buy or sell an individual stock. But there are larger costs, costs that are unseen, which is to say that one cost is that the average mom and pop has no trust in the stock market anymore. They feel like the stock market is a game for big boys with big toys, and that they're likely to be the victims here. And so and you've seen individuals leave the stock market largely, even leaving it to go away from their index funds, and that's a bad outcome. We can't have a major institution like the stock exchanges and stock markets of the country, being things that people have no faith in. And then the second thing is that individuals will be victims of a crash. And if I'm right that the high frequency trading will exacerbate the next crash, the victims won't be the high frequency traders or the big institutional traders. It'll be the mom and pops.
Okay, Jesse Eisinger, senior reporter for ProPublica, a Pulitzer Prize winner. Jesse, can you give us a little sneak preview? Are you working on something else, another book, or are you going to expose another aspect of Wall Street? Can you give
You'll
us?
have to stay tuned for that. But I've actually been working on a series of stories off the financial markets, working on the Red Cross, and we've been examining the Red Cross this year and their failures after Superstorm Sandy to properly get disaster relief to people, and they in fact were misappropriating resources and allocating resources to public relations purposes away from disaster victims. We exposed that a few weeks ago, and we're still looking at it. And I think those are interesting stories for your listeners too, if they get tired of reading market stories.
Okay, we'll keep an eye for that. Jesse Eisinger, senior reporter for ProPublica. Jesse, great interview. I mean, you covered a lot of different subjects. Really appreciate you taking the time out to come on the show. And if it's possible, we'd like to have you on again.
Sure thing. I enjoyed it.
Thanks, Jesse.
Thank you.